Hey everyone, welcome back to volume and spread analysis. Today we are going to talk about volume and spread. At the end of this video, the listener should be able to define what is volume, what is spread, what is volume and spread analysis, the importance of studying volume and spread analysis, what is effort versus the result, how volume interacts. So first you have to understand what is volume. Volume means how many times shares were bought or something was traded at that specific period. So in this chart you can see this is a tick volume from TradingView. There is a difference between the real volume and the tick volume that is being provided by TradingView. Tick volume and the real volume, they don't differ that much. Statistics say that the accuracy of the tick volume is 90% as compared to the real volume. So before we talk about volume, we have to know what a spread is. So spread is the difference between the high of the candle and the low of the candle. So that is what we call a spread. So this is what we call a spread. From this point to this point, this is what we call a spread, and this is volume. So what is volume and spread analysis? So volume and spread analysis is the relationship between volume and how they interact with each other. You cannot use volume without the spread, and you cannot use the spread without the volume. So why study volume and spread analysis? So volume and spread analysis, first, it helps us know why price behaves the way it behaves, why price moves from the support to the resistance, and why price moves from the resistance to the support cluster. The next point, volume helps us to identify the footprints of the large institutions, what the large institutions are doing in the market. A good example, if you look at this volume and then you look at these candles, this will mean that at this particular price level we had large institutions buying heavily or aggressively, and that is what caused this move. Then volume and spread analysis. The market represents a battle between supply and demand. When a trader gets into the market, he is likely to buy or sell, and price will move to the direction of which traders are more. If supply wins, price will decline, and if demand wins, price will increase. So by studying volume and spread analysis, we know which force is going to win a battle between supply and demand. Before we talk about volume and spread analysis, you have to understand about the law of effort and results. The law of effort and results, it states that when you throw a ball with a lot of effort, that ball will move at a greater speed and at a greater momentum. But when you throw it at a small speed, that ball will move at a low momentum or at a low speed. So the law states that the higher the force, the greater the results. The higher the effort you use to push something, the greater the result of that effort. So let's discuss volume and spread analysis in correlation with the bullish market. So if you check, this is a bullish market. So the spread is big, and we talked about the spread is from this high to this low, and the volume is also relatively high. So meaning that the volume and the spread are matched. The spread is big and the volume is high. So the effort that was required to push the price up, it also formed a greater result. Hence, high volume, high effort, high result, or high spread, and that will always result onto a bullish bias. So if you see at this point, the spread is so small, but the volume is relatively high. We have a high effort, but the spread is so small, or the result is so small. So when we have a high volume and a low spread, the result is a bearish bias, and you can see what happened next. The next point, you can see the spread is big, but the volume is low. The effort is low, but the result is big. So that will mean that the force that was required to push this price up was too low, and we never had any opposing force, so the result was big. This is usually what we call an ease of movement. It takes less effort for price to advance. That suggests that we don't have any supply in the market, and the result is always a bullish bias. So let's look at the example in this chart. Let me look at the perfect example in this chart. So you can see, if we look at this bar, you can look at this bar, and then you can look at this volume, the volume is big and the spread is big. So we have a high effort and a high result. This is a continuation of a bullish bias. Then let's look at this spread also. So if you look at this spread and the volume, this spread is small and the volume is big. You can see the volume is relatively high. So we have a high effort and the result is low. This suggesting a bearish bias, and you can see what happened to price. This is what we have learned in this video. We have talked about when we have a high spread and a high volume, this is a continuation of a bullish bias. When we talk about the high volume, we usually mean that volume also contains a high effort, and that high effort produced a high result. We have also talked that when we have a high volume and then we have the spread is so low as compared to the volume, that is a sign of a reversal or a bearish bias. We have a lot of effort, but the effort does not match the result. That will always lead to a bearish bias. We have also talked about the ease of movement. When the spread is too big and the volume is so low, that means the effort that is required to produce a high result is too low. That is an ease of movement, and it means that is a continuation of a bullish bias. In the next video, we learn about volume and spread analysis in a bearish market. So hit that subscribe button.